if you're an early stage company, assuming you've done your homework on like the bank balance sheet and they have FDIC insured accounts, I would rather be a big fish in a small pond there, right? Because, you're going to probably, it's going to be not always be up and to the right. And you need someone to call. Let's say there's a banking crisis, you got to wire stuff out quickly. Like, do you have someone to call, or is it like an 800 number? If you miss a covenant, you know what I mean? And like, now you need to make an amendment. Does the CEO and the credit committee approve this deal, or is it like going to like a different group that's now like handling the portfolio? You kind of need a high touch approach, I think, for a growth company. So like, a mid-sized bank almost makes more sense given, I would want to really stand out and be a big fish in a small pond at like the bank. You kind of want a private banking approach and pick a partner that's going to be there for that.
Is this thing on?
Yesterday's price is not today's price.
Haha, why thank you, Fat Joe, and welcome to Run the Numbers, where I interview world-class CFOs, operators, and the investors who fund them on how to get the most out of your company's performance. This podcast is a playbook of sorts for ambitious people in the worlds of finance, strategy, and operations. Today, my guest is Ruslan Sergeyev, Managing Director of Venture Lending at Hercules Capital. We spend the hour doing a tactical deep dive on venture debt, the different flavors, the levers you can pull while negotiating as an operator, and red flags to beware of. More specifically, we cover the common types of venture debt and why you'd want to consider each one, how venture debt providers are essentially building a portfolio of companies just like a VC would, if companies still need to keep all their excess cash balances as collateral with a bank post-SVB collapse, how covenants, warrants, and success fees work, how much debt you should think about as normal within your capital stack, how VCs and venture debt providers team up on deals, and why the people on your cap table signal to debt providers that you'll be okay, analyzing the major players in the venture debt landscape today, and how to use each banking activity as a chip to get the best deals with banks. This was a masterclass in how venture debt can be a strategic lever for growth. Seriously, there are some golden tips in this one. It was also an honest view of how the ecosystem is working post-SVB collapse. Ruslan has been around the block, having worked for Stifel, PacWest, Golub, and B of A. He's seen multiple innings of the venture debt game and provides specific tips for venture CFOs to keep in their back pockets during negotiations. All this and much, much more after a short word from our sponsors. Mercury knows your financial operations are complex. Founders and finance teams have to pull together different tools, reconcile transactions from different sources, and struggle to get accurate answers. With Mercury, you can simplify your operations with banking and software that power your critical financial workflows, all within the one thing every business needs, a bank account. And with new bill pay and accounting capabilities, you can pay bills faster, stay in control of company spend, and speed up reconciliation. Apply in minutes at Mercury.com and join over 200,000, ambitious startups that trust Mercury to provide the precision, control, and focus they need to transform their financial workflows so they can perform at their best. Mercury, the art of simplified finances. Mercury is a financial technology company, not a bank. Banking services provided by Choice Financial Group and Evolve Bank and Trust. Members FDIC. I'm getting good at that voice. Quick math. The less your business spends on operations, on multiple systems, on delivering your product or service, the more margin you have and the more money you keep. That's the goal, isn't it? But with higher expenses on materials, employees, distribution, and borrowing, everything costs more. Yesterday's price is not today's price. So to reduce costs and headaches, smart businesses are graduating to NetSuite by Oracle. NetSuite is the #1 cloud financial system, bringing accounting, financial management, inventory, HR into one platform and one source of truth. With NetSuite, you reduce IT costs because NetSuite lives in the cloud with no hardware required. Access from anywhere. You cut the cost of maintaining multiple systems because you've got one unified business management suite. You improve efficiency by bringing all your major business processes into one platform, slashing manual tasks and errors. Over 37,000 companies, wow, that's a lot of customers, have already made the move. So do the math. See how you'll profit with NetSuite. And back by popular demand, NetSuite has extended its one-of-a-kind flexible financing program for a few more weeks. Head to netsuite.com/metrics. That is netsuite.com/metrics. Ooh, yeah, you know your boy loves some metrics. That's netsuite.com/metrics. Please do it, guys. I really need this. Ruslan, my man, welcome to the Run the Numbers podcast.
CJ, thanks for having me.
This is the third bank I've known you at, and I've bought venture debt from you at exactly 0 of those places. Do you think this podcast will finally get it over the line?
I have to do what I can to get you to finally kind of move over here. So, I'm pounding the pavement with you at every step of the way.
This is a long deal cycle, but I'm sure you'll get me someday. So speaking of venture debt, I wanted to bring you in because I look at you as one of my friends who's an expert in the space. And a lot of CFOs and finance people listen to this podcast. Some of them may be a bit afraid, though, to ask the stupid question, so I'll do it. Venture debt is a loaded term. It can mean a lot of different things to different people. Can you just start by breaking down the most common flavors of venture debt?
Yeah, absolutely. And I think, the way I would think about this overall is to define venture debt overall, right? It's like, what is it? And I think I would just basically frame it as fungible, non-dilutive growth capital, right? And that's kind of a mouthful. So, basically it's debt financing in lieu of or in connection with equity funding to extend runway or fuel growth while limiting management or early investor dilution, right? And I think what defines it as venture debt is the fact that, the companies that we're lending to all burn cash, right? So as a result, I'm not investing or underwriting to future cash flows of a business to pay down a loan back, but more, gauging the company's ability to raise new equity, have an exit or an IPO of some sort, and bridge to that, or have confidence in the downside recovery there that's meaningfully higher than the debt amount, right? So, that's kind of venture debt overall and why it exists. And then the flavors of that, I think on the bank side, are really more kind of lines of credit and revolvers and more of the private fund side and private investor side. It's really term loans and growth capital, permanent capital into the cap stack.
Why is everybody talking about venture debt now? Maybe it's just in my head that they are, but I feel like more so than the last 2 or 3 years, it's coming up in a lot of conversations that I'm in.
Look, I think I would say there's 2 main reasons for it, right? One is the obvious one, right? And the biggest venture debt provider and bank in the ecosystem had a collapse, right? So all of a sudden, all of the attention's coming down given SVB and all the issues that arose with that. I would say that coupled with the probably continued disconnect of where we're at today in the venture ecosystem, right, with valuations and lower VC fundings overall. So you have tons of companies that have raised at high multiples. Valuations over the previous years are very high as a result, and now are either struggling to hit plan, don't want to or can't raise equity, and or don't want a dilutive down round, right? And so as a result, alternative sources of capital like debt financing plugs that to get to profitability or that next inflection point. What's funny is there's also a ton of M&A opportunities that I've heard about, which companies just want a debt facility in place where, you could probably get a company on the cheap and get some good ARR. I haven't seen that come through yet, but we're also seeing a lot of that a little bit, I would say.
Got it. Hey, one of the reasons why I think companies are looking for venture debt is it kind of allows them to refuse to catalyze the external environment in terms of putting like a valuation on a priced round. But when they do venture debt, you probably have to come up with your own valuation on them, right?
I think we don't come up with our own valuation, but what we really do is spend more time coming up with a distressed sale value, honestly.
Okay.
The meat and bones of kind of what we're doing and evaluating a company is not too dissimilar when you think about an equity investor, right? And it's what is the TAM, what is the market opportunity, competitive dynamics, financial profile, and really digging in on that. But I would say there's that last 20% from an equity investor that's really, what's our IRR, our multiple, exit, and comps. And for us, it's like, all right, well, similar comps that have not worked out, what do they sell for, right? So are we comfortable lending to this business where even in like a worst case scenario, like in the waterfall, we could probably get paid back on it in a distressed sale?
Would it be too simplistic to think about VCs and PE investors as the guys who are thinking more so about what could go right when they invest, and you're thinking about what could go wrong? What's the bear case in this?
Yeah, I think that's perfect.
Because you are essentially building a portfolio, right? I should look at it that way.
Yeah, I think like if you're going to be a bank that's doing this in the space, you kind of need a diversified portfolio where one company is not going to sink you, right? And you have to have almost be indexed to the overall market and ecosystem, right? I think that's where SVB did such a great job historically, right? Because they had such large market share and banked and lent to almost all of the companies that they ebbed and flowed with VC fundings, right? So when you just look at the chart of VC funding and you look at SVB's kind of stock chart, it probably moves, pretty close. And that was part of, what happened a year ago when funding dries up and all of the cash is companies that are burning. So your liquidity goes down consistently without new fundings. And, we all know what happened as a result of that.
And one of the big concerns from startup founders when SVB went down, like it sucked to lose access to a line of capital. But the biggest thing was, hey, I have all my cash parked with them. That was like historically, and I wanted to ask you if it's still the case, but in order to get these facilities done, it's like I have to make you my primary banking partner and I have to park all my cash there. Is that still the case or has that changed at all?
To a degree, it's changed, but maybe let's take a step back and think about why a bank would want to get into venture lending, right?
Yeah.
And I think the name of the game for that is deposits, deposits, deposits. Because when you really think about it, how does a bank really grow its deposit base and grow its AUM? It's getting new customers to come on, right? Or it's buying other banks. And that's hard to do, right? Organically, right? There's a lot of competition out there. But if you're lending in a banking, startup company from the seed all the way through, the exit, think about the life cycle of how much capital that company raises. And that all sits at the bank that then fuels your ability to lend out that cash pretty much free, right? Outside of interest that you're paying. And that's the flywheel. Right. So as a bank overall in the space, any bank is interested in it primarily for the deposit and banking opportunity. Right. And then they kind of like begrudgingly lend because lending to Series A cash burning businesses, it's a riskier game to play for a bank, especially. Right. But the deposit angle is really the core thing. So now, in a new world, it would be obscene to ask for 100% of the cash to sit at the bank, given what happened. But I think where we're settling on is, or banks are settling on, is a little bit closer to 70%, and then keep a couple of months of operating burns, at a money center bank, or just kind of an exit valve, right? And that kind of, you even saw what happened through the crisis, where I don't think there's a risk, or the U.S. government pretty much showed there's not really going to be a risk of losing your cash unless there's an unpredictability there. It's just more disruption risk of how long, until things get sorted out, maybe another bank buys those deposits. There's a lot of uncertainty to deal with. So belt and suspenders is definitely now pushing companies toward, having primary cash at a venture bank if you're going to get a loan, probably an ICS type sweep account that's FDIC insured, and then a belt and suspenders, couple months of burn somewhere else at a money center bank to kind of really be set up.
I like how you pointed out, though, the life cycle of a customer, in the sense that, that was SVB's whole name of the game. They get in with this starter $5 million facility. Next thing you know, 5 years later, they still have their talons in you. And now you're doing $250 million in revenue and you're worth a lot more. And they also got some cheap warrants in the process, but they took that risk and that bet early on and gave you really good terms on something that was small because they wanted to grow with you over time.
Exactly. And really the funny thing is, from the bank side, a debt fund's lending into companies, I'm at Hercules now, right? And when we lend into companies, it's truly use our debt, please. We're permanent capital and partners, and we can talk about that later. But from a bank perspective, right, when I was, on the bank side, we're giving debt facilities to companies that just raised equity, right? As a runway extension. Here's, you have a year or two to draw it, draw it when you need it between rounds, or just additive fuel to the fire. So in reality, a lot of companies don't even use it, right? They kind of put it as an insurance policy. And what I saw the stat was, on the bank side, our debt utilization was 30%. So realistically, they're probably never or rarely even use the debt, but now you're in there banking them, and it's a 10-to-1 deposit to debt utilization ratio.
Wow.
Debt commitment, right? So that's why it's profitable, and that's why banks, get wide-eyed and want to do it. But executing on it is a different story. And in this environment, when cash was 100% a bank, made a lot more sense. But I think we're in flux here, and different companies and boards have different perspectives now.
That's a good rule of thumb. I didn't realize that only 30% were tapped.
Yeah, especially on the bank side, right? Because it's lines of credit and stuff where, you're using it. Maybe there's working capital swings. Maybe it's bridging to that next round. Maybe it's really tapping up for an M&A. But really, a lot of them don't even need to, right? Because you have the debt facility, but things are going so well, you're just raising this next equity round a lot of times.
If there was another rule of thumb, and I don't know if you have this off the top of your head, but what percentage of debt deals get done in conjunction with an equity raise at the same time?
I would say most bank debt deals get done in conjunction with the equity raise, right? And that's partly given how the kind of terms you're going to get from a venture bank. They really think about it as one, like, the investor cap table and how much they know them. Two is the financial profile. And then three is cash runway without any debt, right? So if you have a lot of deposits to bring over to the bank and also have a lot of runway, good boards or investors just get a debt facility in place right away that's going to be the most flexible on covenants and structure and things like that you probably have the loosest deal when you have the most cash, because you can bring a lot of that over to the bank and you just look like a company that doesn't actually need the debt.
I like how you brought up covenants. You're leading me in my next piece here. So what are the typical covenants that banks will impose on startups?
I think, so what is a bank solving for if you're lending into the space, right? Again, it's investor support. And as a result, the covenants are structured around inflection points, right? So what does that mean in reality? It means like if you're trying to grow and what do your investors care about for you hitting that next round or investor support? Is that 100% growth? So the covenants are more growth covenants in alignment to kind of what the company is like solving for. So if you're going to burn and try to hit a growth target that will then get you your next equity raise, banks will discount to that to give you cushion to it, but at least have that kind of inflection point. And those are the most common, either revenue or ARR target at a discount to your forecast. I think, what are you solving for? And now in this environment, it changes a little bit, right? Because now everyone's trying to get profitable or cut burn. So sometimes we would do, covenants that give you a cushion to your cash burn. But it's really aligning for what are you solving for? And we'll just covenant to that, basically.
Okay, so the covenants aren't like out of the box, like, hey, it's a revenue, a gross margin, and a bottom line. What you're saying is you look at what their 3 or 5 year plan is and try to align to that.
I think good, smart, non-lazy lenders do that, yes.
What would your advice be for CFOs who are trying to get the best terms or covenants? Do you look for rate or flexibility? Which lever are you pulling?
That's the funny thing to me, and I'll kind of soapbox a little bit about it. But you get into deal processes, and I think people lose sight of like what are you solving for if you're trying to get a debt facility in place, right? And to me, you should really, especially in this environment, like just solve for access to capital and flexibility. That's kind of when you're running your business, do you want to constantly be worrying about this covenant or that? Because there's a trade-off on rate and structure. And a lot of times, maybe it'll be more expensive, but you're gonna have looser covenants as a result. And to me, if I'm running a business, I would want the least amount of covenants or the loosest ones possible if I'm gonna be using a debt facility. So to me, when people get cute about like cutting rates and comparing, it's like we're talking like let's do the math on the difference between this rate and that versus a covenant. And it's like $100K a year, right? And it's like I know you want to look good internally to some of that, but just like solve for the easiest capital possible to run your business and kind of move on.
What are bankers most likely to move on in terms of terms? If I come in and attack you on both fronts, covenants versus rate, what's easier to move?
I would say, so right, a debt structure is going to have covenants from a bank, right? Covenants, rate, and then like warrants or back-end fees. And I think you're most likely to be able to have, the team on a bank move on the warrants or the rate.
Got it.
Like, I mean, the warrants are the reason why you can kind of take that risk a little bit, right? If you think about a portfolio approach, you're doing a bunch of these Series A loans to companies that are burning cash. I mean, do the math on how many Series A companies have an exit and are successful versus not. And the warrants are, small ownership percentages to offset the risk, right? So it'll maybe be 10 to 30 basis points, fully diluted ownership. So in turn, I think, the theory, and this has proven out true if you're doing this long enough, is, the winners of the Series A loans that you do will return, warrant returns at an exit, high valuations will more than offset the losses that you take lending the Series A company.
Really?
Basically. So, that's kind of like the trade-off and why the warrants are there if you think about it on a portfolio approach. So, it aligns the risk. And also, this is the other thing where people negotiate to try to get no warrants and no fees. And I get all that. But sometimes you kind of want the people that are your lenders to be on the side of also wanting to pop the champagne with you at the end, right? So it's kind of like
have some skin in the game.
Yeah,
you mean?
Because now you get this great deal and you grinded people down and like they have no economics and like
they're pissed at you.
like you might need them later, and why would they do anything for you? You know what I mean? So like solve for greed a little bit too.
Yeah, I look at it like the other side has to eat too. And if you grind them down over the deal and get it done, but then you hate each other for the next 3 years that you have this revolver, it's like, well, that didn't really work out. And then if you go back and you need to upsize it, he's like, all right, well, this is where I get my pound of flesh.
Yeah, or like, hey, I'm gonna miss this covenant. Like, could we like make an amendment? And it's like, yeah, sure. I need this company to succeed too. You know what I mean? So that it makes it easier to do that.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Cash is king. As the CFO of a SaaS company, I know firsthand how important it is to maintain a healthy AR balance. If you can't effectively manage cash, you can't service debt, make payroll, or invest in growing your business. That's why I'm so excited to partner with the sponsor of today's episode, Maxio, the leading billing and financial operations platform for B2B SaaS. Maxio helps top SaaS companies like Chili Piper, Crunchbase, and Stack Overflow get cash in the door faster by automating collections and dunning. Gone are the days of manually chasing down invoices. Join the 2,500 plus subscription businesses using Maxio, formerly SaaS Optics and Chargeify, to eliminate revenue leakage and streamline order to cash. It's never been easier to get paid. Visit maxio.com/run the numbers to supercharge your financial operations in 2024. Not only does requesting a demo using the Run the Numbers link help support this podcast, ya boy, you also receive a 10% discount on your first year with Maxio. Woo! That's maxio.com/run the numbers. That's maxio.com/run the numbers. Okay, serious question for all my accounting pros here today. Are you doing what you were hired to do? What I mean is, do you have time to actually be a business partner, or are you buried in tedious manual tasks just to get your journal entries prepared every month? I know how that feels. Leapfin's here to help with that. Leapfin is accounting automation software that automatically prepares and posts reliable journal entries. And that's just the beginning. High-growth businesses like Reddit, Canva, and SeatGeek choose Leapfin to eliminate manual tasks, accelerate month-end close, and enable accounting leaders like you to provide faster insights that will help your company grow. If you're battling messy transaction data from Stripe, Adyen, Shopify, Apple Pay, and other PSPs, and then battling again to get it all into NetSuite, go to leapfin.com to watch their short product intro video. And if you like what you see, request a 15-minute conversation to learn how accounting automation can help you and your team. Check out leapfin.com today. That's leap like jump, fin like shark. I just made that up. I hope they're okay with it. Leapfin.com. What's a success fee then? Because that's also on the back end.
Yeah, that's kind of sometimes usually instead of a warrant, right? And sometimes it's kind of a fixed fee. A warrant can be pretty variable, right? It's like, you get it at the valuation of the last like 409A, and that's what is that today, right? And you're right, if you really hit a home run, that can be very meaningful upside that the company kind of is giving away a little bit. So sometimes the success fee is instead of a warrant, and it's similarly just like a fixed dollar fee that's only paid out in an exit or like an IPO or something. So it just adds a different lever of economics to not give up warrants, but it's just like a fixed fee that's only paid out at an exit.
In my simple mind, I look at warrants like I'm just hiring one more exec at the company because it's usually between 10 basis points and 50 basis points. So like if I'm a Series C company or D company, it's the price of adding like a high priced SVP or like a C-suite person.
Yeah, that's a smart way to think about it, actually. That's pretty interesting.
Yeah, I don't know. That's just how my mind works. This is kind of like having the fox in the hen house a bit. I don't know if you're going to give me a straight answer, but when would I not want to raise venture debt? Don't tell me never.
No, when not to? I think this is a misconception I hear of like, insurance policy, this and that. But at the end of the day, like if this is like your Hail Mary and like you've exhausted all your other options and it's kind of like the last branch before like you're out of options, just that's the bad time to do it. It's really, no one's going to have a good time with it. Or even if you have it and then you're going to draw it as like, this is our, like, let's see what happens. Like the lender's going to be all over you as a result. Like they can see your cash balance. Nobody has a good time in that scenario. So like I would say that use venture debt as like an additive or substitute when things are going well and like you could raise equity, but you just don't want to for like a myriad of reasons. But like worst comes to worst, like you could do down round, you can raise something like you don't want the dilution, or here's an opportunistic capital that you really want to like add fuel to the fire, you use venture debt for that. If it's like we're screwed and we need like a lifeline, it's not a good match.
Yeah, so it's not a lifeboat.
No.
But how much debt is appropriate for a capital stack?
You know, I've gotten that question before, and I would say, look, I think a rule of thumb is like 20 to 30%. I think if you look at like debt to equity ratios of like public SaaS comps, it's like 40+%. But
Yeah.
my advice would be, look, if you want to look really good internally, you just raised the round, right? And you're going to your board, and here's the plan and what we need to execute this plan with the capital that you raised over the next 24 months before like the next raise. What I would do is say, well, if we miss this plan, like this is scenario planning, and like what if we're at 70% of that, and like we don't really want to cut burn? What is the hole to fund this plan? That's the plug amount that I would have and get the debt facility in place for coming off the equity round. So then you can show like, here's us on plan, and if we're off plan, we also have the capital to execute and get to this inflection point regardless. And that's how much venture debt I would raise.
I love how you brought up scenario planning, because I always look at venture debt as part of different scenarios. I hate when people say like use it as a blanket insurance policy. I'm like, that means I don't know what I'm doing.
Yeah.
It means I'm just like trying to solve for an unknown. I want to be solving for an what's probabilistic to happen in different scenarios, and use venture debt as one of those levers.
Exactly.
What about sizing? Should I think about these in like t-shirt sizes, like extra small, small, medium, large, extra large? Well, what are the typical sizes of these venture debts?
I mean, look, at a bank, it's interesting, right? I mean, the way to think about where I want to be, the way I would frame it of where do I want to be on debt versus like a revenue or ARR perspective.
Yeah.
And like the sizes, I mean, here at Hercules Capital, we can go up to like almost 300 hold sizes on our own, right? And start early. But to me, it's really by the time you used all your cash and debt on the balance sheet is greater than cash, right? So now you're really leaning into debt.
Right.
That's when I want to be at like half a turn of like debt to ARR. That's when I feel like pretty well covered on like recovery values, right? And like you leading into it. So like at close, if you have your own runway and you have debt availability and like that's like 2x debt to ARR, to me that's fine because you're kind of using your own equity anyways. But when you burn through that and you grow and now you're at a point where you're really leaning into the debt, that's our true exposure. And at that stage, I kind of want to be at half a turn.
Got it. So you think about debt in terms of turns of ARR. That's a good way to look at it.
I think so. I would say, a rule of thumb on recovery, like, because truly, like, you got to be a little bit of a pessimist to lend into, cash burning companies. Optimist too, just to be in venture overall. But like, if you're lending to that, all right, well, so speaking of scenario planning, right? It's like, what could go wrong? And like, a lot of distressed, decent companies still sell at like 1x ARR, right? So you really want to be under that to have good enterprise value coverage when you think about a loan to value of a business.
And part of the reason why I wanted to do this podcast is just to educate finance people when they do go into the boardroom and they have a venture debt facility that they're thinking about getting approved, what even ratios they should be using to present this business case back to their board.
Yeah, and the good, it's funny, right? At the early stage, those numbers get funky because like you have $2 million of ARR or no revenue, but you have like $20 million of cash, and at that point, it's kind of you're kind of underwriting cash in the cap table because like there is no revenue, right? Or it's so early that like you don't know, so it's really planning out how much runway and burn do you have, and then setting up adequate inflection or maturities that are generally inside of that auto extend once you're hitting milestones. But like once you're scaling up and you're 10, 15, 20, $30 million of ARR or like revenue, you can kind of get between, half a turn to one and a half debt to ARR is on really good profiles. But that's kind of the range.
And for the benefit of listeners, you're looking at like, hey, this thing would at least sell for 1x ARR because you get paid before the equity holders.
Yeah, exactly.
Okay. So that's how the liquidation scenario would go down. Hey, one of the other reasons why I was pumped to have you on is that you're at Hercules now, one of the top players in the game. You're on the A team. You've been around the block at some awesome companies, and you've seen this evolution over the last decade of what's gone on within venture debt. Can you just give like your perspective on the landscape of how it works today and who the big players are?
Yeah, and it's so interesting, right? Because that landscape today is different what it was a year ago. And I would even say it's going to be different a year from now.
Like there are less players than a year ago?
It's funny enough. I would say there's more players.
What?
Right? Like think about it. So a year ago, before SVB, there were, mostly regional banks that were doing this. because the deposit game, right? If you're like Bank of America or even JP Morgan, who did this selectively, like you don't care about you're so large, it's not really like a driver of growth for you to kind of be lending to or banking companies that are small early stage businesses. So it was historically regional banks and then SVB, who was like the huge market leader in the space. So those banks were like Bridge Bank, Comerica, PacWest, Avid Bank was kind of getting into this and those kind of players. And then you had, the SVB, JP Morgans of the world that were also like lending into that space. And then there's funds as well, right? The historical venture debt funds like Hercules, Trinity, Triple Points of the world. Post collapse, and SVB is still back now. That landscape's changed, and that's changed for a couple of reasons. One, there was a disbursement, right, of talent where everyone's kind of shifted. We didn't, people didn't know what was going on, so a lot of really, A players at SVB left, right, and a lot of banks saw, the void and the opportunity to enter the space for reasons that I said, be it, large investment banking opportunities, taking market share, et cetera. So now you have players like Stifel, which hired a lot of people from SVB and has been doing this for a while, but have stepped up from that side. You have HSBC, which also hired a ton of talent from SVB and is being very active. SVB is still around. JP Morgan's around. Those smaller regional banks are all around. So, ironically, you would think that like the terms would get worse for companies because there was a banking crisis in the macro, but so many people have gone and started these practices at new institutions that are now in market, and they have to build their own portfolio, right? So now they're actually like, getting a little bit more aggressive, and that's kind of offsetting, the pullback. So I would say, right, that's today from the bank world. And as a result, the options are there, but a lot of these players haven't gone through like a cycle, right? So you can talk a big game of like why venture debt is good, but truly understanding who's going to be around long term and who's just kind of like a tourist in the space is something that I think will still evolve over the next year or two.
Do these guys like to play together? Does it vary based on how big the loan is? But like I'm just making it up. Does an Ares or an Owl Rock not like to share in deals with the others, or like the club deals go down? So
those funds you mentioned, that's like the other world of like, venture and tech lending. Those are non-banks. So like Hercules ourselves, we're like a roughly $5 billion private debt fund with like a public BDC as well. Right. And similar to like Owl Rock, those guys are really doing middle market lending, and they're coming down as well, kind of down market given the opportunity of venture. So, when I think about a bank, most banks really don't want to hold, or from what I've seen, more than like 50. So if there's a senior bank deal that is at the ask is high, they'll club it up and partner up a little bit. So sometimes when I was on the bank side, like HSBC would call me up and be like, hey, like we only want to hold 30, but the ask is 50. Do you want to hold 20 of it? So there is a partnership opportunity when you get into higher debt sizes. And then similar for debt funds, like ours, where, you kind of de-risk, where the total debt amount might be 200 on this business that's really large, but I'd rather hold 100 of it just given, risk perspective, because that's a big, that's a big commitment amount if anything does go wrong to get like tied up. So, when you're dealing with huge hold sizes, that's fine. I would say anything under 50 though, like usually doesn't get partnered.
That's an interesting line of demarcation. I appreciate that. And I'm also asking because if you're a CFO out there pitching to VCs, they want the whole deal, right? They don't want to share it. They're all competing for it. But I guess there is this element of where the risk profile like starts to turn. Like, I don't want to be the one left holding the bag of all 50 of this. Yeah. That's when you start to say, hey, do you want to partner on it and kind of diversify?
Exactly.
How do you think about banks versus funds? You brought up a second ago that Hercules isn't a typical bank. What's the difference there? Does that mean you're not going to make me park all my cash there if I work with you?
Yeah, look, I mean, it's interesting, right? I don't care about your bank, who you bank with. I'm not trying to sell you any other treasury or deposits, right? We're private credit investors that are permanent capital in your balance sheet, right? And what that means is, I'm willing to take more risk than a bank. And as a result, our deals have no covenants in them at all. The maturities are longer. It's really long-term investing into you from a debt perspective with nothing else tied to it, right? Because the bank is not really lending to you because they want you to borrow. They want to be part of your overall life cycle, right? And cross-sell you, be your credit card partner, be your banking partner. It's one of a whole product suite that makes sense for being into the space. So you'll get a lower rate at a bank, but again, they'll have covenants, it'll be less flexible, there might be some structure, and that makes sense for a lot of companies as well. But a fund is doing this to be a long-term investor. And I definitely want to touch on the fact that what we're seeing today in the ecosystem of venture lending is not too dissimilar from kind of probably what happened coming out of the previous bank crisis in 2008, right? Where, a lot of these banks have obviously had issues, and as a result, there comes regulatory scrutiny, there comes, a uncertainty of predictability from the banks. So as a result, sophisticated, financial sponsors and investors came to the private debt market to kind of get probably a little bit more expensive debt, but you're dealing with private investors. It's one investor, not a bunch of different banks. They're much more flexible. They can go deeper on leverage. And that's how you saw the huge boom in private credit to how big it is today and why it's there. And that was coming out of the financial crisis, right? Because it's, why lock up a long-term debt partner, which has unpredictability if they'll be in the space, if there's going to be regulatory pressure on these leverage loans, et cetera. And I think, today, not too dissimilar, there's, the banking model is different, right? Not 100% of the cash is sitting there. There's regulatory pressure from the OCC coming down on bigger banks. And, other companies are really solving for, like I said earlier, access to capital in the most non-dilutive and flexible, no covenant manner. And that's where debt funds are coming in and filling that void.
If we do zoom in on the banks, though, specifically, and you think about all the different services that a bank can offer, venture debt's one of those skews, right?
Yeah.
Which skew historically is the moneymaker for the bank?
They want to be plugged into your operational banking. That's the long term, right? I mean, what do they get wide-eyed on? It's your cash deposits that are coming over. Especially today, what do investors and regulators care about? It's liquidity of banks. So the name of the game is deposits and how can you grow the deposit base and get your ratios well. But what the bank really cares about is credit card and just being in the interchange flow of your operational banking. And
what about like an account I use for payroll? Is that important to them? Do they make a lot of money off that?
I think, the payroll accounts, the AR, the treasury, I mean, they just want to be your main treasury service provider, and the credit card. The credit card can be very lucrative for banks, especially for startups that are spending a ton of money on ad spend, sales and marketing, et cetera.
Do you think venture debt is more top of the funnel for other banking services, or it's bottom of the funnel, like you do the other things first and then you end up doing venture debt? And I ask too, maybe with like the overlay of the investment banking side of the business, banks doing venture debt deals in hopes of like also helping with your IPO or something like that. How do you square those activities?
So on that first question, it's funny. I think a bank would love for venture debt to be bottom of the funnel. But in order to bring someone over and kind of open a bank account with you, you have to lead with the debt term sheet first, right? Until you get the flywheel going where you're SVB and everyone's already coming to you and just opening accounts because you're all they know in the space for venture. They had such a great market share, and they honestly still do, of doing that. But, for myself, who wasn't at SVB, and we had to claw to win deals against like the market leader, which honestly was a lot of fun. But we really, the bank wanted the deposits in the banking. So I was tasked with winning the debt deals, and in turn, that's kind of what you have to, get people excited about first to get.
You were the front door?
Yeah. So it's usually top of funnel.
Usually top of funnel.
I think it's funny, right? Because the banks that have been doing this in the space, what is interesting to companies? It's having a good interface, easy usability, and they're going through that today. But I mean, a lot of bank interfaces look like they were built in 2002, and these regional banks were not ready to handle and work with venture companies. They love the deposits, but it took a while to kind of move that forward. And there's a lot of awesome companies out there that have helped kind of bring digital transformation to banks. So that's in process now. But before that, it's why would you open an account with this random bank that has poor, a poor interface and usability? Well, the answer is, they'll give you a pretty good loan. So that was historically kind of how it worked, and now I think everyone is smart enough to that and utilizing a lot of the fintechs in the ecosystem to help bring that forward, so they don't have to. I mean, the dream of a venture bank is to get the banking without doing the loan, for sure.
Okay.
But you really, that's a hard game to play, so you kind of got to do the loan as well.
Do you think venture debt ever acts as the front door for investment bankers to come and do deals later?
Absolutely. That is, that's kind of, that's where JP Morgan does a really good job of it, where, sometimes, at least that I saw, they're so big, and they play in so many things. Sometimes it's why are you bidding or do you want this small business of like this tech company? But that's kind of where the investment bank comes in and really pushes very aggressive terms.
Oh, really?
They want to get in there. So, JPM is the catch-all anyways, because everyone goes to them as like a flight to safety. So you almost have to be like a venture bank as a result, because people are just opening accounts with you, especially post SVB. And they hired a lot of great people. It's a focus, but I mean, it's $1 trillion bank. So how does your Series A company stand out there? That's kind of the other end to think about. But when they come in very aggressively on debt deals that like you look back and you're like, I'm surprised they're doing that. It's because there's push from the investment bank because they really want you to get in there.
Because they want an allocation if you do well.
Yeah, exactly. And they kind of want an inside track, right, to win the IPO business, to win the investment banking business, et cetera, for some of these growth companies. And that's like,
you mentioned some of the smaller banks getting a deal with like a JP Morgan. Do you want to be the smallest or one of the smallest clients in the bank's portfolio? Does that mean you will get a lot less attention?
Yeah, it's funny. That's what I used to, sell against a lot of times back in the day, of the fact that like, if you're an early stage company, assuming you've done your homework on like the bank balance sheet and they have FDIC insured accounts, I would rather be a big fish in a small pond there, right? Because, you're going to probably, it's going to not always be up and to the right. And you need someone to call. Let's say there's a banking crisis, you got to wire stuff out quickly. Like, do you have someone to call, or is it like an 800 number? If you miss a covenant, you know what I mean? And like, now you need to make an amendment. Does the CEO and the credit committee approve this deal, or is it like going to like a different group that's now like handling the portfolio? You kind of need a high touch approach, I think, for a growth company. So like, a mid-sized bank almost makes more sense, given, I would want to really stand out and be a big fish in a small pond, like the bank. You kind of want a private banking approach and pick a partner that's going to be there for that.
And just to call out to some of the other CFOs, there are a lot of times where you get wide-eyed and bushy-tailed about like, oh, like Goldman wants to work with me. It's like, yeah, but are you getting Goldman's C or D team? Like just because you want to be able to work with them, you got to size that up. Like who, and are they going to pick up the phone when you call?
There's that, right? And it's funny because sometimes obviously like, you'll get a really good term sheet from like an investment bank that obviously just wants the investment banking service. But like the way I would think about it is, I don't know, if you're a company, why do you want to be locked in that early? You're going to want to shop it and pick the right investment bank or IPO partner down the line anyways. So it's almost like more pressure to work with someone that you picked early versus just like having optionality later to just evaluate before you pick up a banking partner. So like, yeah, that's a big chip for them to throw, is like, we're a lender to you as well. But again, that's just a way to get incumbency. Similarly, it's top of the funnel for other banking services, right? That's where banks lead with venture debt.
I want to talk a bit about debt versus equity. So in your opinion, why do VCs always want to give you money when the company is doing really good and doesn't need it? Isn't that actually when companies should look at less dilutive options like venture debt? Isn't that when they should pick up the phone and call somebody like you?
Yeah, well, CJ, I've been, soapboxing that for a long time, but like, it's like there's at the end of the day, there's a disconnect, right? And one that makes sense for why and what the board wants you to do a lot of times versus kind of what makes sense for management. Right, because the board, if things are going well, they have LPs and good investors want more ownership in your business if it's going well, right? That helps their own return profile and IRR. So like, if I invested at a seed or a Series A and I have a huge equity portfolio and access to capital, I would want to double down and triple down on your winners, right? And really take as much equity ownership of that business as you can before exit, and that'll really juice the whole fund return. So that obviously makes a lot of sense for the equity fund. However, for management, right, at every step of the way, if you're raising these huge mega rounds, that's very dilutive. So there's usually like a balance of utilizing capital, right, because it's all fungible, and how much of that you're raising equity with, and how much you're plugging the rest of that with debt. And even if you go online, there's a lot of good like case studies and examples of management equity. If you just did like 10 to 15% of every round with debt financing versus equity versus all equity, and you can see how that line of ownership between all equity and then equity plus a little debt at every stage like really gets pretty wide for the management team.
What's the relationship then between VCs and venture debt players? Are you guys at odds with each other, or do you work together?
No, interestingly enough, I think it's pretty symbiotic, and we do work together, right? I think when I was on the bank side, you kind of you raise a round, and the good boards and VCs that know debt providers and capital providers like that loop us in right out the gate, right? Because there's no better time to raise venture debt from a bank than when you don't need it, and when you don't need it, just coming right off an equity round. So they'll just loop it in because they understand access to capital is very important for cash burning companies. So just get something in place if push comes to shove and you need to extend that runway or something happens quickly. So a lot of times they're the first ones that are calling us, or we're pinging them to kind of get looped in, and vice versa. And then that's also, the relationship there is important because in a downside scenario, right? Like if I'm lending to you and things aren't going well and you're getting tight on liquidity and all of my debt is outstanding, like who am I going to call? I'm going to call, your investor on your board and be like, all right, real talk. Like, are you guys putting more money into this, or like, what are you thinking here? Like, I don't want to be involved, or I'm not an operator. I'm not trying to work my way out of this deal. Like, so it's, the good VCs know when to call it or know how to support it or kind of get it to soft landing or a space and get debt investors paid back. And in turn, if I can't act like an asshole to you if you bust the covenant, because then, your board will be pissed at me and then they won't send me any more deals. So it's a very relationship-based kind of ecosystem.
I'm glad you dissected that, because that's the inside baseball people come to the pod for. And a lot of people may not notice that, like, say, A16Z has a certain, bank that they call to help with that, their portfolio. And I also didn't realize even until now that maybe you're calling the board members to have a relationship with them as well. Because in essence, you're on the cap table too.
Yeah, exactly. We're kind of, without even being told about it or right, and without having the rights, we're kind of like soft board observers anyways, and being close to like what's going on, and usually have catch-up calls with the partner on the board, like quarterly, of like, so like what's going on with the business? How are you guys thinking about it today? Are you trying to put more money in? Like, what do you need to see before you guys would want the company to raise a new round, right? And that's kind of how we get smart on some of that inside baseball that's going on at the board level. So it's a really relationship-based approach. And I would say, funny enough, right, there's funds that like everyone knows very well that like can write huge checks, but when push comes to shove, they'll just walk away from the deal because they'll be like, all right, I'm calling it, like this, it's not going to be this one, right? So then they don't support those. And some of those are pretty big name funds that like people get wide-eyed, oh, like this company led by this. But ironically, you kind of want to know the people in the relationship and some funds that you've gone through a workout with that are good actors and can really work through that with their debt provider and lender and company and get everything to a soft landing, and ones that care, and those get better terms. Because when I'm going to my investment committee, it's like, well, it's, Fund C, and we've been through workouts with them and they've been awesome partners and they've supported this business or they've gotten it out. And then in turn, that gets much better terms from a lender as a result.
And you were saying you actually look at the cap table to see who's on it to say, like, do I believe in these guys, or do they have lended credibility here?
Yeah, exactly. That's one of the three key drivers of like a venture debt underwrite is the cap table and how well we know them, and have we ever gone through like a downside scenario with them, and do they support their businesses or not, and is there a personal relationship there? Because it does come down to being a relationship business at the end of the day.
I love that. I love that time, because if shit goes down, you want to know that they're going to help the company get to at least 1 times ARR at sale.
Yeah, and kind of what I even look at, right, is like how long ago did this fund that we even know like invest, right? If this company is long in the tooth and like the last round from this fund was like 2015 and they didn't even step up for like a pro rata for that next round, it's like, then that's kind of reading the tea leaves of like how much they're ready to step in and support their business or not. So like you almost underwrite the business, but then underwrite the investors and like their capital reserves, their availability to support, what vintage is it invested out of? Do they have any dry powder left in that vintage fund, et cetera? So that's part of the work that we go into as well to really understand that. Because again, if you're leaning into the debt and maybe things aren't going perfect and you're getting tight on liquidity, like who am I going to call, right? And that's kind of the most important thing to understand from the cap table side.
And that's the due diligence of looking not only into the operating profile and financial profile of the company that you're underwriting, but also looking at, are these guys even going to get out of bed in the morning to help this company? Like, Is this fund 8 years old and they're just like phoning it in at this point? You want someone who's highly motivated on year 2 of that fund and also has dry capital that they can deploy.
Exactly.
I want to talk about managing banking relationships. So in your opinion, how should CFOs think about the different chips that they have at their disposal? So we talked about a couple of them, like your checking account, your sweep account, your venture debt, the longer term treasury stuff. Should they bank primarily with one for each of those, or should they have kind of one core banking partner for all of it?
I think, right, like what does the bank want? They want a core banking partner for all of it, right? So right now, today, you could probably get away with just moving a lot of, if you have a lot of cash deposits, and then like, kick the can down the road of long-term banking. But like, they just want to be plugged in, right? They need to be like the primary operating bank that's seeing a lot of the flow, the in and out flows, payroll, AR, all coming in through them. That's kind of the
Yeah.
core. And part of that is like it's kind of a pain to switch banks, right? Especially like the larger you get. So when you're plugged in there, it's kind of that's like the long-term incumbency that can keep you at a bank way longer, right, through that life cycle. And because a lot
It
of
sucks to
times,
change banks.
yeah.
It sucks.
So that's the trade-off, right, of a fund. You don't have to change banks, and you can just it's going to be slightly more expensive, but that's kind of where I sit nowadays, and kind of talking about that. I mean, look, at the end of the day, the banking, the relationship, the deposits, the bank health, it's just like a very large part of the conversation nowadays, and rightfully so. So everyone's doing their diligence on it, but like a bank's going to want the liquidity and deposits, right, because that's what they care about.
Yeah, that's most important.
So long term, they want to be plugged in, but I think the deposit story is the most important right now.
And I always thought they cared about certain things because it made the most money fee structure wise, but you're saying it's because of the regulators to look at it and be like, nope, you guys are good over there.
Yeah, exactly. I think, that can ebbs and flows in good times and bad, but right now with all the pressure on banks overall, like, they're getting watched a lot closer. So the more liquidity you have, the easier it is to kind of manage, and that's kind of what everyone would solve for. It's what I would solve for too.
Yeah.
I want liquidity and deposits at the bank well outsized of any kind of debt outs and loan commitments I'm doing.
All right, maybe gearing towards a close. Red flags. Any red flags that founders or CFOs should have their spidey senses out for when they're going through the venture debt process?
To me, I would say if you're getting a term sheet so quick, right, from a process, and I don't think that it's obvious they didn't really like do their homework, or you didn't get like a deep diligence dive, and now you just get this like crazy good fast term sheet. That's kind of a red flag to me, because at the end of the day, it's like, then if things don't go well, you kind of want to be with someone that like gets the business, knows why it's not going well, is like prepared for it, has had that discussion, and has like thoroughly thought through and now presented you with like a good term sheet.
Wait, you're saying if they make it too easy on you, that's a red flag?
Yeah, exactly, right? Because it's like, then they don't really get your business, and like quick money in is going to be quick money out from a bank perspective, and the lender, right? Then they're going to balk and be like, no, because they don't get it. And the credit committee might not get it. It's very aggressive. I don't know. To me, a fast term sheet means you didn't do your homework, and you really need to do your homework in venture to kind of be a good lender.
What else may be like, hey, this might not work out?
It's funny how I used to say it, or what I would always kind of advise people on, especially when I was, at Pac West and we were kind of like trying to really compete, is, if you're not going to go with us, then just go with SVB, because like you should be with somebody and like a lender that has been in the space long enough to go through like a cycle, right? And like a debt cycle, because again,
somebody who's seen some shit, you mean?
Exactly, right? Because like, again, it's easy to want to be lending into this space, be it a fund or a bank, when things are going well and it's easy. But like, are you ready to take some losses, which you will have when nobody's doing VC funding, and like a lot of the macroeconomic situation turns, and all of a sudden, who's actually in it, for the long haul or not? And that's a thing that I would lean toward. But it's funny because everyone's kind of dispersed, and you have a lot of good people now go to a lot of these other banks that are new, right? But they have hired like veterans from institutions that have been doing this for a long time. So, I would caveat what I just said with a small addition, and it's go with people you trust, and work with them. So given, the bank has, who knows, like, what bankers went where, or who's at what fund now, work with people you trust that have been in this industry for a long time, and lean on that more than anything.
Nice. And so you're at Hercules now. What type of deals are you looking to do? What's in your strike zone these days?
Yeah, one of the awesome things about being at Hercules is how flexible, this fund is given the size. Being the oldest and largest, private fund and capital provider that's not a bank in the space, there's a lot of levers to pull. So what we're really doing right now, our strike zone is, as low as like 10 million, up to 300 million, but truly trying to be, in a wider band and flexible and scaling up. But what we're doing is a lot of companies today that have already done that growth equity round, right? And now you have a high valuation, but the business is good. You're maybe not growing as fast to grow into that. But from a management team's perspective, you really don't want to do another growth equity round or take that down round, right? But like you have your eye to what you need to do for maybe a Series D, maybe a sale, maybe an exit. And that's kind of where we're really coming in and plugging that because, from a bank perspective, a company like that doesn't have a lot of deposits to show, right? You've burned down on cash. Maybe you already have some debt outstanding, but you really need to solve for capital to execute on your plan with no covenants and kind of get to that next inflection point without worrying about moving your banking or doing anything of that nature. So, we're really truly spending a lot of time being permanent, long-term, flexible capital providers for the long haul for a lot of these companies without any of kind of the bells and whistles that come with bank structure.
Love it. This has been a masterclass in venture debt. Like there's this whole other side of the world. We usually talk about the cap table from an equity perspective, but like this has been illuminating. So I really appreciate you coming on, man.
Yeah, absolutely. I always tell everyone, you give me a platform to talk venture debt, I'm there. So
love it. I owe you a beer for this one.
Yeah, for sure. This has been great.
And best of luck on the new baby that's due.
Oh, thank you. Yeah, I've reserved the fact that I'm not going to be sleeping much this year between, a hot venture debt market and a new kid.
Yeah.
So we're ready to roll.
All good stuff. Thanks, man.
Yeah, no problem, CJ. And, thank you for hosting this while also simultaneously, leading a rocket ship of a company, Parks Tech. So
appreciate it, man.
Thanks for having me.
Run the Numbers is a mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, LOL. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.